Hi, I'm Race Kershey, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. So, as we move into the last quarter of 2020, investors' attention is focused on two key and interrelated issues. The first is whether the spread of COVID-19 is under control, and the second is how quickly or otherwise is the U.S. economy reopening. Starting with COVID-19, the topic has undoubtedly turned into a political football, so it's probably best not to get distracted by political hearsay and to do our best to stick to the available data. At the end of October, the CDC published a report stating that of the 161,332 deaths where COVID-19 was listed on the death certificate, 6% had COVID-19 as the only cause mentioned, and 94% had COVID-19 listed alongside other causes. Now, that doesn't mean that there's been a miscategorization of data, as some have suggested, but it does imply that the lethality of the virus on its own is less than initially feared. Recent research from Stanford scientists has been published by the National Institute of Health, which is the organization that Dr. Fauci heads up. It concludes that people under 65 years old have very small risks of COVID-19 death, even in pandemic epicenters, and deaths for people under 65 years old without underlying predisposing conditions are remarkably uncommon. They advocate strategies focused specifically on protecting high-risk elderly individuals. Now, pandemic aside, it has been a tense summer, with nationwide protests erupting and continuing to this day. Whether a Trump rally or a Black Lives Matter protest, I think we can all agree that social distancing has gone out of the window in a lot of areas, and there has been a corresponding uptick in cases. However, hospitalizations and deaths data haven't followed, and with this in mind, it's worth remembering that viruses by nature mutate, and that can mean their virality decreases. Now, we understand that markets price in all available information, and also appreciate that there's been huge amounts of stimulus which has supported markets. However, if we were seeing an uptick in death and hospitalizations instead of just largely asymptomatic cases, it would be reflected in the price action. Which brings us neatly along to the question of the economy reopening. Now, there's no doubt that the U.S. economy has rebounded sharply since the late spring, as we can see in this chart, which plots the Citigroup Economic Surprise Index for both the U.S. and emerging market economies. The index plots the degree of deviation or surprise contained in macroeconomic data releases compared to Wall Street analysis consensus forecasts for that data. The U.S. economy has surprised to the upside since early May, and has done so with conviction and upside momentum. However, that upside momentum has begun to fade. That may be because analysts are now setting higher hurdles for the U.S. economy to beat, but it could also be because the economic recovery itself could be faltering. U.S. consumers are at the heart of the economy and are responsible for up to 70% of the country's GDP. COVID-19 has caused dramatic changes to the economic landscape and to consumer behavior. We only have to look at spending pattern data to see just how large the changes in consumer behavior have been. For example, during 2020 to date, spending by Chase Bank credit and debit card holders fell by 24.4% at gas stations, 20.4% at restaurants, and 52.7% at hotels and lodgings. Spending with airlines all but evaporated, falling by more than 80% according to data from Chase Bank's parent, JP Morgan. Of course, there are areas of the economy that are benefiting from the changes in spending patterns that COVID has introduced. For example, data from Goldman Sachs this week suggests that video conferencing apps have seen year-over-year growth of 620%, whilst online fitness apps and the use of social video game streaming services have grown by 82% and 62% in that time frame. Online payment services and mortgage applications have experienced growth of 33% and 28% respectively. Overall, Goldman rates the change in economic activity over the last 2 weeks as positive, and the score of its composite economic reopening indicator moves up to 72 versus a reading of 100 recorded in February 2020 before COVID-19 hit. A proprietary platform, Trackstar, can shine a light on which stocks and sectors of the economy Wall Street traders and professional investors have been looking at over recent weeks. For now, headline stocks like Apple and Amazon remain in heavy focus for obvious reasons. Perhaps not surprisingly, electronic vehicles rank highly in Trackstar data. And though Tesla dominated the list, Challenger NIO featured highly and was the only NYSE-listed stock in the top 15 stocks ranked by unique user searches. Advertising agencies are seen as being leading indicators for the economy, and Trackstar data shows that the sector has been given a thorough inspection by Wall Street traders. 13 separate tickers from this sector appear in the Trackstar search trends, and there are more than 120 unique institutional investor users investigating advertising stocks. The average advertising agency stock is still down by 35.6% year to date, so this sector is a perfect barometer for improving investor sentiment around a fuller economic recovery. So, in answer to today's questions, we feel it's probably worth tracking the data closely and paying attention to deaths and hospitalizations rather than newspaper headlines and total cases. From there, while the reopening trend is underway, stocks like advertising companies are most definitely a useful indicator. As always, we are in a very fluid and unpredictable period. The modern economy has never been shut down by a pandemic in recent years, so we are in uncharted waters. So, before you make any investment decisions, make sure you've done your due diligence. Safe trading!